Hello, welcome to IPTM. Today, we're ready for a very special deep dive. This is actually a summary from a payroll classroom session led by the Indian payroll trainer, Mr. Ajit. IPTM's goal is always to give you that shortcut so you can get well-informed really quickly. So today, we're going to explain and summarize the professional tax, or P-tax, session focused on India. Our mission is to make sure that you, our payroll learners, clearly understand everything covered in that session and also, explore some great learning opportunities for your career that came out of it. So, expert speaker, what's our mission today, really? Nail it down for us.
Well, our mission is to unfold every nuance of professional tax, especially within India. What's fascinating here, I think, is that this isn't just another compliance requirement. It's really a foundational pillar of the Indian payroll system. We're going to look at why it exists, how it works, and just how essential it is for any payroll professional to understand inside out.
Okay, let's start with the basics then, the foundational question. What exactly is professional tax? Where is it applied? And, well, who has to pay it?
Right. So P-tax, as the name kind of suggests, is a state-level tax. That means it's not levied by the central government, but by the individual state governments in India. It's levied on individuals who earn income through a profession or a trade or employment. So this covers salaried employees, definitely, but also professionals like chartered accountants, doctors, engineers, the usual suspects, freelancers too, and even businesses themselves.
Okay, let's unpack that a bit. So how is it different from, say, income tax? They sound kind of related.
Yeah, they do, but they're quite different. Yes, absolutely. Income tax is levied by the central government, right? It's uniform across the country. P-tax, on the other hand, is collected at the state level. Some key characteristics are only state governments collect it, employers usually deduct it from employee salaries and then deposit it with the state government, and maybe most importantly, it's only applicable in certain states and union territories, not all of them. That's a huge point.
Okay, that state level thing is key. Does it have a proper legal basis then?
Oh, absolutely. It's rooted in the Constitution. Article 276 of the Indian Constitution grants state legislatures the power to levy taxes on professions, trades, callings, and employments. But, and this is a crucial point, there's a maximum annual limit. Per person, per year, it's capped at $2,500. This amount is for the entire financial year. It doesn't matter what the monthly deduction comes out to be. That $2,500 cap is really important, something we absolutely have to remember.
Right, $2,500 max per year. Got it.
Yeah.
So you mentioned it's not applied in every state. Can you give us a rundown? Which states and union territories currently have P-tax as of, say, mid-2025? And where is it not applicable? This seems vital for anyone with operations in different parts of India.
Certainly. It is vital. So as of August 2025, the states and UTs where P-tax is generally applicable include Andhra Pradesh, Assam, Bihar, Chhattisgarh, Goa, Gujarat, Jharkhand, Karnataka, Kerala, Madhya Pradesh, Maharashtra, Manipur, Meghalaya, Mizoram, Nagaland, though there might be specific conditions there. It's not always straightforward in Nagaland. Then Odisha, Puducherry, Sikkim, Tamil Nadu, Telangana, Tripura, and West Bengal. It's quite a long list.
Wow, yeah, that's a lot of them. And where is it generally not applicable then?
Okay, so the states and UTs where P-tax is generally not applicable include places like Arunachal Pradesh, Chandigarh, Delhi, Daman and Diu, Dadra, and Nagar Haveli. Himachal Pradesh, Jammu and Kashmir, Lakshadweep, Punjab, Rajasthan, Uttar Pradesh, Uttarakhand, and the Andaman and Nicobar Islands. It's really important to understand this distinction because if your company operates in, say, both Maharashtra and Delhi, you'll have P-tax obligations for your Maharashtra employees, but not for the Delhi ones. It dictates where your compliance efforts need to focus. And just a very important caveat here, applicability and the specific rules, the slabs, everything, it can change. State governments do update these things. So it's always advisable to verify with the latest state government notifications. Don't rely on old information.
You've made that crystal clear. So for you listening, if you're based in a particular state or maybe doing business there, it's absolutely essential to check if P-tax applies. Don't just assume. This isn't just a box-ticking exercise. It's fundamental for your payroll planning, your compliance, everything. Really highlights the need for that localized knowledge in India, doesn't it?
It absolutely does.
Okay, this is where things get really interesting, I think, because you mentioned P-tax isn't the same everywhere it applies. Can you tell us more about these state-wise variations? What makes it so varied?
Exactly. Understanding the complexities here is really crucial because each state truly has its own set of income slabs and, importantly, collection methods. This lack of uniformity is what makes multi-state payroll such a challenge. For example, you have states like Kerala, Tamil Nadu, and sometimes Karnataka that lean towards collecting P-tax annually or, more commonly, half-yearly, whereas most other states, like Maharashtra or West Bengal, they collect it monthly. Now, annual or half-yearly collection often means deductions are based on slabs covering a 6-month period, like in Kerala and Tamil Nadu. So you might only see a deduction twice a year.
Ah, okay. Monthly versus half-yearly. That's a big difference in processing.
It is. And another challenge, sometimes overlooked, is language. In some states, the forms, the government websites, they might be primarily in the local language. This can obviously create difficulties for professionals or businesses operating there who aren't fluent in, say, Kannada or Marathi. Plus, things keep changing. We've seen recent changes, for instance, in P-tax regulations in Bangalore, or new requirements for proper authentication of IDs for deductions. All this just underscores the need to stay constantly updated. You can't set it and forget it.
Really interesting stuff. The diversity itself is a challenge. So could you give us some examples, maybe illustrate the slab rates for a few major states, just so our listeners can get a concrete idea of how different it can be?
Sure, let's look at a couple of key ones. Maharashtra is always a good starting point, big state, lots of employment. Their monthly salary slabs are like this. For men, up to 7,500, it's nil. From day 7,501 up to 10,000, it's 175 per month. And above 10,000, it's 200 euro per month. But here's the Maharashtra twist. For the month of February, the deduction is 300 for those in the top slab.
300 in Feb. Why the change?
It's purely to hit that annual cap. See, 200 a month for 11 months is 2,200. Add the 300 for February, and you land exactly on the 2,500 annual limit. It's how they manage the cap. And interestingly, for women in Maharashtra, there's no P-tax if their monthly salary is up to 10,000. So a gender-based exemption there.
Wow, okay, that February adjustment is a really important detail. So keeping that annual cap front and center is absolutely vital. It shows you need to track the whole year, not just the monthly rate.
Precisely. Now let's contrast that with Karnataka. It's much simpler. Up to 15,000 monthly salary, it's nil. Above 15,000, it's a flat 200 per month. That's it. No February adjustment needed because 200 times 12 is 2,400, which is comfortably within the 2,500 annual cap.
Yeah.
Quite straightforward.
Much simpler, yeah.
Then you have West Bengal, which uses more tiers. Up to 10,000 is nil. Then 10,001 to 15,000 is 110. Euros 125,000 is 130. And it goes up in steps from there, but again, always respecting that overall 2,500 annual cap. Andhra Pradesh is similar, nil up to 15,000, then slabs of 150 and 200. States like Assam, Bihar, Gujarat, Telangana, they all have their own different slabs and rates too. And then back to Kerala and Tamil Nadu, their system feels quite different because of the half-yearly slabs and collection. For instance, in Kerala, it's nil for earnings up to 11,999 half-yearly. Then the slabs go up 120, 180 euro, 300, and so on, up to 12,250 for earnings of 1,025,000 and above half-yearly. But again, the maximum annual limit of 2,500 still applies, so the two half-yearly payments can't total more than that. Same principle in Tamil Nadu with their half-yearly structure. So the takeaway here is that it's absolutely crucial for employers to refer to the specific P-tax Act and rules for each state where they have employees. Because these rates, these rules, they are subject to change. You need the latest official information for each location.
That's incredibly detailed. Thank you. Yeah. So for you listening, you can really see the sheer number of variations and nuances just for this one tax. It underscores why payroll teams must ensure deductions follow state-specific rules precisely. Calculating P-tax based on whether it's a monthly, semi-annual, or annual slab system in that particular state, it's a precision job.
Absolutely.
Now, P-tax isn't just about making deductions, is it? Employers have some significant statutory responsibilities. Could you walk us through those, maybe step by step? What does an employer actually need to do?
Yes, absolutely. The responsibilities are quite structured. The very first step, and arguably the most fundamental, is registration. Employers typically need to get two types of professional tax certificates. One is the Professional Tax Registration Certificate, usually called PTRC, and the other is the Professional Tax Enrollment Certificate, or PTEC. These are the foundational documents for compliance.
Okay, PTRC and PTEC. They sound similar. What's the actual difference between them? Why two?
That's a great question. It often causes confusion. So the PTRC is mandatory for employers who deduct P-tax from their employees' salaries. Think of it as the employer's license to collect the tax on behalf of the government. It authorizes them to deduct and remit. The PTEC, on the other hand, is for the employer themselves. It's for the business entity, the company, the firm, the proprietor, the professional, to pay PTECs on their own status of being engaged in a trade or profession within that state. So the company pays PTECs for existing via PTEC and also collects it from employees via PTRC. Now, in some states, a single registration might cover both aspects, simplifying things a bit, but conceptually they cover two different liabilities. When do you need to register? Well, employers usually have to register within a specified period, often 30 days, of either starting business operations or hiring staff in a state where PTAX is applicable. Missing this deadline can lead to penalties right from the start. And crucially, if you operate in multiple states where PTAX applies, you need separate registrations for each state. One registration doesn't cover all locations.
Right, state by state. Okay, let's dig into the registration process itself. What about documents? What kind of paperwork do you typically need? Does it vary much?
It does vary state-wise, which adds a layer of complexity, but there's a set of common documents you likely need almost everywhere. These include the PAN card of the company, partnership, or proprietor, the certificate of incorporation or partnership deed. For companies, the memorandum and articles of association, MOA and AOA. You'll need proof of your business address, utility bills, lease agreement, that sort of thing. Identification proof for directors, partners, or the proprietor, like Aadhaar or PAN, and their photographs. Bank account details, often confirmed with a canceled check. And specifically for the PTRC, a list of employees with their gross salaries might be required upfront. Plus, a digital signature is often necessary for online applications these days. Now, for those state-specific quirks, in Maharashtra, for example, they might ask for a copy of the Veropafti, which is a municipal tax receipt, plus passport photos of the signatory. In Karnataka, you might need a list of any other branches you have in the state, the company's TAN number, and maybe even 4 photos of the authorized person. Punjab often requires photos and a municipal tax receipt too. Andhra Pradesh might ask for a GMC Greater Municipal Corporation tax payment receipt, along with PAN and Aadhaar details for all directors. These variations really show that the HR or compliance team needs to maintain an updated checklist of required documents for PTAX registration in every single state they operate in. It's not a one-size-fits-all process. The actual registration process usually involves filling out an online application, submitting the prescribed form. Some states use specific form numbers like Form 1 for PTRC, Form 2 for PTEC, uploading scanned copies of all those documents we mentioned. Then there's usually verification by the state's commercial tax department, and once approved, they issue the certificates.
That's a very thorough look at registration. So once an employer is registered, the next step is actually deducting the tax. How does that work month to month?
Right. So PTAX is typically deducted monthly from the employee's gross salary based on which income slab they fall into for that specific state. The most important thing operationally is to ensure that the total deduction over the financial year doesn't exceed that Euro 2,500 cap we talked about. And as we saw with the Maharashtra example, this often means adjusting the deduction amount in the last month of the financial year, usually February, to hit that U 3,500 mark exactly if the standard monthly deduction would otherwise undershoot or overshoot it. PTAX should be deducted right from the employee's very first salary payment, assuming their income falls into a taxable slab for that state. No waiting period. And yes, it's mandatory to clearly show the deducted PTAX amount on the employee's payslip. Transparency is key. The employee needs to see exactly what's being deducted and why.
Makes sense. Are there any exceptions, like situations where PTAX isn't deducted even if the salary is in the slab?
Yes, there are some important exceptions. Employees with a permanent physical disability, as certified by relevant authorities, are generally exempt from PTAX deductions. This is a common exemption across most states. Also, it's worth noting that the PTAX deducted is actually allowable as a deduction under Section 16(3) of the Income Tax Act when the employee calculates their own income tax. So it reduces their taxable income slightly. There are also specific rules around directors. If a director is also an employee of the company drawing a salary, the PTAX is usually deducted from their salary by the employer under PTRC. They don't need to pay separately just for being a director in that case. However, non-working directors who might receive sitting fees but not a salary may still need to enroll and pay PTAX themselves under PTEC for holding the position or calling of a director. The specifics can vary a bit by state, so it needs careful checking. Doctors serving as directors also fall under these rules based on their specific arrangement with the company. So the payroll team has a big responsibility here to ensure deductions align perfectly with the state rules, slabs, and exemptions. And the HR team needs to ensure employees are classified correctly, which state's rules apply, are they eligible for exemption, are they a working director, etc., and keep those records updated.
Okay, deduction covered. Now, the money's been deducted. How and when does the employer actually pay this collected amount over to the government?
Right. Collecting is only half the job. The employer must then remit the collected P-tax to the respective state government. The frequency of this payment, whether it's monthly, quarterly, or sometimes even annually, depends on the state. It can also sometimes depend on the employer's size, like the number of employees or the total P-tax liability. Some states might allow smaller employers to pay quarterly to reduce the administrative burden. Generally, for monthly payments, the due date is often the 10th or 15th of the following month. So P-tax deducted from July's salaries would typically be due by August 10th or 15th, depending on the state's rule. For those self-employed individuals paying under PTEC, the payment is usually annual, often due by a specific date like June 30th, or sometimes aligned with the financial year end. How to pay. Most states now have online portals run by their commercial tax departments. Payment can usually be made via net banking, credit debit cards, and sometimes even UPI. It's generally quite efficient. Offline payment using a designated challenge form at specified banks is often still an option, though online is usually preferred and sometimes mandatory. The payroll team's critical task here is ensuring these payments are made on time, every time. Missing the due date triggers interest and penalties almost immediately.
Right. Hitting those deadlines is crucial. And you mentioned HR might provide login credentials sometimes.
Yes, particularly for online systems. If certain employees, like maybe those self-employed professionals or non-working directors who need to pay their own PTEC, require access to the state's portal, HR might facilitate setting up their login credentials or provide guidance on how to do it. It ensures everyone who needs to pay can do so easily.
Okay, payment done. What about filing returns? Is that a separate step? How does the employer report everything officially?
Yes, filing returns is a distinct and mandatory step after payment. Employers have to file periodic returns again, could be monthly, quarterly, or annually, depending on the state and the registration type. These returns essentially summarize the P-tax collected and remitted during that period. They typically include the employer's PTRC PTEC registration number, the period the return covers, details of the employees, like name, maybe PAN, gross salary, and the P-tax deducted for each. The total P-tax collected across all employees, and proof of the tax remittance, like the Challen reference number or payment transaction ID. Any changes in the employee roster, new joiners, leavers during the period are also usually required to be reported in the return. The filing process itself is predominantly online now through the state's commercial tax portal. You usually need to prepare the return in the format specified by the state, sometimes directly online, sometimes uploading a file. Once submitted electronically, it's vital to save the e-filing acknowledgement. That's your proof of filing, absolutely essential for records and potential audits.
It sounds like there's a lot of documentation involved throughout this whole process: registration, deductions, payments, returns. How important is meticulous record keeping?
Oh, it's absolutely crucial. Record keeping is the bedrock of compliance and audit readiness. Without good records, you're exposed. Employers must maintain copies of their PTRC and PTEC certificates. They need detailed monthly payroll records showing employee salaries, the P-tax deductions, and how they were calculated. They need proof of payment, the challenge, or online payment receipts for all remittances made to the government, copies of all the P-tax returns filed, along with those acknowledgments we just mentioned. And importantly, any correspondence with the P-tax authorities, notices received, replies sent, clarifications sought or given. Basically the entire paper trail. How long do you need to keep these records? Generally, various state laws and often the Income Tax Act implicitly require records to be maintained for a minimum period, typically ranging from 5 to 8 years after the end of the relevant financial year. You need to be able to produce them if asked during an audit or assessment.
5 to 8 years. Wow. Okay. This all sounds quite rigorous. But what happens if things go wrong? If an employer doesn't follow these regulations, fails to register, pays late, files incorrectly, what are the consequences?
Non-compliance can lead to some pretty serious consequences, primarily financial penalties and interest charges, but it can also impact the company's reputation and potentially lead to legal hassles. For instance, failure to register for PTRC or PTEC when required can attract a fixed penalty, maybe $5,000 or $10,000 or even more, depending on the state, and potentially additional tax liability assessed for the entire period of non-registration. Some states might even levy a daily penalty until you do register. Late payment or non-payment of the deducted tax. That attracts interest charges, usually calculated monthly. Rates like 1% to 2% per month, or even part of a month, are common. So even a few days delay can mean paying interest for the whole month. On top of the interest, there's often a separate penalty for late payment, which could be a fixed amount or a percentage of the tax due. Failure to file returns on time or filing late. Similar story. Penalties can range from fixed daily fines that accumulate quickly up to a percentage of the tax liability for that period. And providing incorrect information returns can lead to even heavier fines, as it might be viewed as willful misstatement. Perhaps one of the most significant risks. If an employer fails to deduct P-tax from an employee's salary when they should have, the liability often falls on the employer. They might be required to pay the tax themselves, plus the associated interest and penalties. The employee is generally absolved in this case, as the onus was on the employer to deduct.
Ouch. Paying the tax yourself plus penalties sounds harsh. So to make this real for our listeners, can you give us a practical example? How would a penalty calculation work in a typical scenario, say for a late payment?
Sure, let's take a simple example. Suppose a company in Karnataka needed to pay professional tax of 5,000 euros for the month of April 2025. Let's say the due date was May 20th, 2025. But, they actually made the payment on June 5th, 2025. So they're late. Let's assume the late payment interest rate in Karnataka is 1.5% per month or part of a month. The delay runs from May 21st to June 5th. Now, even though that's only about 15 days, because the law often treats part of a month as a full month for interest calculation, this delay spans across 2 calendar months, a part of May and a part of June. So interest might be charged for 2 months. The calculation would be 5,000 tax due, 1.5% monthly interest rate, 2 months, it equals 150. But wait, there's more. On top of that 150 interest, the Karnataka P-Tax Act might also impose an additional penalty for late payment, perhaps a fixed sum, or a percentage of the tax due. So the total hit could be considerably more than just the interest amount. It shows how quickly these costs can add up from even a short delay.
That's a really clear illustration, thank you. And it really hits home, especially as you, our listener, heard from Mr. Ajit's session summary. DIPTI was specifically tasked with calculating interest and penalties for delayed payments in Maharashtra. It proves this isn't just a theoretical risk. It's a real-world, practical challenge payroll teams deal with regularly.
Absolutely. It's part of the job.
So, given these potential pitfalls, what are the best practices? How can HR and payroll professionals and business owners avoid these penalties and ensure smooth compliance?
Right. Avoiding penalties and ensuring smooth sailing requires a proactive approach. There are several best practices. First, and maybe foremost, stay updated on state-specific laws. P-tax laws, the slab rates, due dates, forms they can and do change. Regularly check official state government websites and reliable compliance update sources. Second, automate payroll processes wherever possible. Use robust payroll software that's kept up to date with the latest state-specific slab rates. Good software can automatically calculate P-tax, reducing manual errors significantly, especially if you're handling multiple states. Third, ensure timely registration. As soon as you establish a presence or hire employees in a state where P-tax applies, get the PTRC and PTEC registrations done promptly. Don't wait. Fourth, maintain accurate employee data. This includes correct state of employment, salary details, joining leaving dates, exemption status, garbage in, garbage out of place here. Incorrect data leads to incorrect deductions. Fifth, regularly reconcile deductions and payments. Make sure the total P-tax deducted from payslips matches the amount actually remitted to the government each month or quarter. Investigate any discrepancies immediately. Sixth, create a clear compliance calendar. Map out all the P-tax payment and return filing due dates for all relevant states and set reminders well in advance. Don't rely on memory. Seventh, embrace digital record keeping. Store all your P-tax related documents electronically, organized by state and financial year with proper backups. It makes retrieval much easier and safer. Eighth, conduct periodic internal audits or reviews of your P-tax processes. Just check if everything is working as it should. Identify any potential weaknesses before the authorities do. Ninth, ensure your HR and payroll teams are well trained on P-tax regulations. Regular training updates are essential. And 10th, don't hesitate to consult with tax professionals or payroll compliance experts, especially for complex scenarios like multi-state operations, mergers, or unusual employee situations. Getting expert advice can save a lot of trouble down the line.
Those are excellent, really practical best practices. Now, thinking specifically about audits, which can be stressful for any business, what are some key tips for audit readiness? How can companies be prepared if the P-tax authorities decide to take a closer look?
Audit readiness really comes down to being organized and having your documentation in order beforehand. First, maintain organized files, both physical and ideally digital. Categorize all your P-tax related documents logically, maybe by state and then by financial year. This makes finding anything the auditor asks for quick and efficient. Prepare monthly or quarterly reconciliation statements that clearly show the total P-tax deducted from payroll versus the total P-tax paid via challenge and explain any differences. Auditors love good reconciliations. Ensure you have a clear audit trail for everything from the initial payroll entry showing the deduction through to the payment challenge confirming remittance and finally the filed return acknowledgement. Every step should be documented and linked. It's also helpful to have a designated person or team who is well versed in the company's P-tax compliance and can confidently and promptly address any queries the auditors might have. And think proactively. Don't just wait for an audit. Regularly review your own processes as if you were an auditor. Are the records complete? Are the calculations correct? Are the filings timely? Self-correction is key. In terms of specific documentation to have ready, company-level documents like PTRC, PTEC certificates, employee-level documents like payroll registers clearly showing deductions, maybe sample pay slips, records of exemptions, financial records like bank statements showing the payments, the actual challenge, or e-payment receipts, and all compliance filings, copies of returns filed, and their acknowledgments, plus any relevant correspondence with the department. Having all this readily available makes the audit process much smoother.
That's great advice. Being organized and proactive seems to be the theme. Now, let's bring it back to the actionable insights from Mr. Ajit's session. There were some very clear next steps outlined for the team involved. Could you summarize those for our listeners? It gives a real sense of the practical tasks involved.
Yes, certainly. The session concluded with specific actionable steps highlighting the distinct but coordinated responsibilities of the payroll and HR teams and some goals for automation. For the payroll team, the key tasks were ensuring P-tax deduction happens strictly according to state-wise rules and regulations, no guesswork. Accurately calculating and deducting P-tax based on the correct monthly, semi-annual, or annual slabs, always keeping the $2,500 annual cap in mind. Maintaining proper documentation for all P-tax registrations and contributions made, that record-keeping point again. Handling P-tax payments correctly for both working and non-working directors, understanding the different requirements. Keeping salary registers updated with accurate P-tax deductions reflected. Ensuring timely P-tax payments and overall compliance with state authorities to avoid those penalties. And specifically, calculating and deducting P-tax for employees earning above the specified limits in each respective state. For the HR team, the focus was more on the employee data and initial setup. Updating employee records with the correct state-wise P-tax rates and the applicable deduction frequency, monthly, half-yearly, etc. Maintaining that updated list of documents required for P-tax registration in each relevant state. Ensuring proper classification of employees based on state rules, identifying who is liable, who is exempt, like physically handicapped employees. Maintaining records specifically for those exemptions, like the disability certificates, providing login credentials for online P-tax payment systems to relevant employees or personnel who might need to self-pay or manage certain aspects, and ensuring the company itself has the proper registrations, PTRC, PTEC, in place with state authorities. Then there were some team-level automation goals mentioned aimed at improving efficiency. Implementing an automated CTC calculator, ideally with one-click functionality. Creating a video tutorial for the P-tax return filing process, likely for training purposes, updating Excel sheet formulas used for any pre-tax calculations to ensure accuracy, developing a feature in their P-tax calculator to allow selection based on state-specific salary definitions. Implementing employee code selection in the calculator, potentially linked to gender options where relevant, like in Maharashtra, and creating and securely managing login IDs and passwords for the state-specific return filing systems. And finally, there were examples of specific roles assigned, which really brings it to life. Someone named Sneha was tasked with ensuring a registration code surrender for Maharashtra employees, maybe they moved or the entity changed, handling the annual return filing for Maharashtra, and processing a return involving the employer's own PTEC contribution of €2,500. And Dipti, as we mentioned, was tasked with calculating the interest and penalty for delayed payments in Maharashtra. Real specific tasks.
That is an incredibly comprehensive list. So for you listening, you can see this isn't just abstract knowledge. It translates into a very practical, actionable roadmap for day-to-day payroll and HR operations in the real world. It really shows the depth required.
Exactly.
So wrapping up today's deep dive, we've really explored the deep and pretty essential world of professional tax in India. We've seen it's not just a simple tax, but actually a complex web woven from unique state requirements and absolutely crucial employer compliance responsibilities.
We learned how P-tax operates under Article 276 of the Constitution with that all-important $2,500 annual cap. We saw just how much variation exists across states in deduction slabs, collection frequency, and payment procedures. And we emphasized that it's not just about getting the numbers right, but also about the critical importance of accurate, thorough record keeping and adopting a proactive approach to compliance to avoid those potentially hefty penalties.
So how was that for you? Did this deep dive spark any aha moments? What new insights will you take away from this information? And perhaps more importantly, how might you apply them in your own career or business context?
You know, all of this detail about state-level variations and responsibilities maybe leads us to a bigger question, something to ponder. How do state-level taxes like P-tax actually shape the dynamics of Indian federalism? What role do they play in empowering states financially, funding their own revenue generation, and supporting their welfare programs? It really shows that payroll isn't just some isolated legal or administrative function. It's deeply connected to the country's broader economic and governmental fabric.
That's a fascinating thought to end on. Thank you all for staying with us through today's deep dive. And just a reminder, if you're looking for live sessions or more personalized guidance on topics like this, do check out the upcoming IPTM courses and consider joining a live training. If you found this deep dive useful and want to keep learning, don't wait. Watch the next video now and keep adding to your knowledge base. Thank you for being part of the IPTM community. Happy learning and keep growing. Thank you.